Hello and welcome to the Morningstar series 3 Stock Picks. I'm Emma Wall and I'm joined today by John Stopford, manager of the Investec Diversified Income Fund. Hello, John.
Hi.
So what's the first pick you'd like to highlight today?
Okay, so all of the investments that we look to own, we're building a portfolio from the bottom up across a range of different asset classes, and the key criterion for us is they have to have an attractive yield, but ultimately it has to be sustainable. It can't be one that's subject to a lot of potential risk. And generally we want things that are attractively valued, supported by fundamentals, and also attracting investor behaviour. So the first example we have is a stock we like, Cisco. It's a business that's somewhat in transformation, so it's evolving from a sort of old tech hardware transactional-based business to one that's reliant much more on recurring income, which we think is a very valuable commodity. So about 30% of the business now is an annuity stream. It's pretty attractively priced. It's a moderate yielder. We don't want to chase yield. It yields about 3.25%, but it has growing free cash flow, improving margins, free cash flow yield of about 8%. And it's only paying out about 40% of its revenues in terms of dividends. So there's plenty of scope to support and grow a dividend over time. And it's generally a business that we think has got good quality, good value, and where we can see a decent return to shareholders, which is at least half of the free cash that they generate, they look to return to shareholders either through dividends or in addition through buybacks. So it's a perfect company for us.
And the second pick is a little less well known, isn't it?
Yeah, so we're running a fund that can invest across different areas, different asset types. So we also invest in listed property, which we look alongside equity. It's another growth-orientated asset. And they're a company that we've liked for some time is a REIT called Tritax Big Box. So they're in the business of running large distribution centres. And there's a trend going on with online retailing growing, etc., for companies to centralise their distribution. So something like M&S, which is a client of Tritax, they used to have about 100 distribution centres, and they're now down to 3. So that consolidation supports, we think, demand for these big-scale sites, and Tritax is a leader there. They have very long leases, typically well over 15 years on average. They're currently earning a yield of around 4.5%. And they're growing at about 3.5% a year. So it's a pretty stable, not hugely exciting business. We're in the sort of defensive area of the market, but a decent yield, some growth, and relative stability in an area that we think is benefiting from change.
And how sensitive are they, though, to losing a key client? I think you mentioned before we started rolling, Amazon was a client of theirs. They're, of course, the leader in the e-retail business. If they lost Amazon, would they be?
Well, at the moment, there's a shortage of these kind of sites. So it's all about the location, so particularly in terms of things like roads and rail networks. It's about the size of the site and availability, etc. And there is, at the moment, a shortage of supply versus demand. There are more companies looking to centralise than there are sites available. In time, that may change, but at the moment, it's a pretty secure business, we think. And then also, you know, they're generally locked into pretty long leases. So on average, I said over 15 years lease. So yes, Amazon might try and get out of it, but it's not obvious why they would. I mean, the bigger risk, I guess, is that some of their clients might fail. But I think they'd be able to replace them fairly easily.
And what's the third and final pick?
Okay, so again, the first two we've talked about are basically growth-orientated assets. They'll do well when economies are doing well. Portfolios have to have more defensive positions as well. The problem for investors is finding defence and yield at the same time. So one of the areas we like is the local government funding agency in New Zealand. It's owned 20% by the New Zealand government and then the other 80% by 30 municipalities, and they're committed to maintaining the same rating as the New Zealand government, so they're essentially supported and they're deliberately targeting high quality. They're currently rated, I think, AA+ by Fitch and S&P in line with New Zealand. But because they're an agency bond rather than the government itself, they typically pay you a yield premium anywhere between 40 to 90 basis points at different points along the curve. And so we own, for example, the 5.5s of 2023. They'll behave like a government bond, but they're yielding closer to 3%. Which in today's world is pretty good, and in a market where we think we're going to get rate cuts, which is generally pretty good for government bonds and linked bonds like that. So New Zealand rates were cut earlier, well, they cut last month, and they've said that they're likely to ease policy further. So defensive asset, supported by monetary policy, decent yield, what's not to like?
When 60% of the market, the government bond market, is yielding less than 1.6%, pretty attractive.
Exactly.
John, thank you very much.
Thank you.
This is Emma Wolf from Morningstar. Thank you for watching.